Hello, and thank you for reviewing our proposal. We're presenting the financial assessment of opening a 100 Mondatitos franchisee in the W Hotel beachfront area of San Sebastian, a location with consistently high pedestrian flow and a tourist-driven consumption pattern. Just in the first 3 quarters of 2024 alone, the city welcomed over 10 million tourists. We're Team C302. I am Nicole, and together with my team, Alexandra, Marley, and Juliana, we're excited to introduce you to a business opportunity we believe in. We've spent the last weeks building a solid financial plan to answer one key question. Can this business deliver real long-term value for its investors? We've worked through every detail, from market assumptions and operation costs to investment needs and returns. And we're here to show you why we believe this project is not just viable, but promising. Let's talk you through what we've been building, what we've planned, and most importantly, why it's a smart investment. Our investment thesis is straightforward. This is a mature franchisee model with well-established costs and process structures. The location offers reliable daily footfall, reducing demand volatility. The business generates predictable free cash flow after the initial investment phase. The analysis we will show you follows the standard corporate financial valuation framework: income statement performance, reinforcement through balance sheet behavior, conversion into cash flow to the firm, and derivation of the terminal value, NPV, IRR, and MIR. Our model is intentionally conservative and is aligned with the case specifications. Revenue began at €500,000 in the first full year and grew 2% annually, reflecting modest market expansion. The cost of goods sold declines from 32% to 30% due to franchisee purchasing economies. Personnel costs remain fixed at 25% of sales, and royalty fees are fixed at 8% of sales per franchisee agreement. Other operating costs begin at €10,000 and increase 5% annually. There is no assumed pricing expansion, no aggressive volume ramp, and no speculative margin growth. This is a risk-aware, stable growth scenario, consistent with financial evaluation standards. And all of this requires a limited initiative investment, €110,000 upfront, followed by only minor investments each year to keep operating running smoothly. With assumptions established, we move next to profitability. Marley will show now the income statement.
Now that we've established the operating assumptions, we move into the income statement, which essentially tells us how the business performs operationally. So we begin with sales of 500,000 in the first full year of activity. This value is consistent with benchmark performance of a similar franchise units in coastal tourist zones, and it grows at just 2% annually, which reflects organic growth rather than aggressive scaling. Moving to the cost structure, COGS gradually decreases from 32% to 30%. This improvement, however, does not rely on efficiency we must create. It is a direct result of the franchise's centralized procurement agreements. Personnel costs also remain steady at 25% of sales, which reflects a well-defined shift-based staffing model with minimal overtime volatility. The royalty fee is also fixed at 8%. This cost is non-negotiable, but it also provides brand equity, training, supply chain access, and marketing support. After accounting for these expenses, we get EBIT, which steadily increases over the forecast horizon as revenues grow modestly while margins stabilize. Applying the 30% corporate tax rate, we derive EBIAT, which reaches 105.7 thousand by 2031. This number is crucial. It represents the steady state annual earnings power of the business once it is running efficiently. This is the number that will ultimately drive the perpetual cash flow and therefore the valuation. Now, as an essential part of the income statement, depreciation is the technical core here. The 330,000 investment is not depreciated in pieces, but as one single asset block straight line over 10 years. That gives us 33,000 per year in base depreciation. We then add 1,000 per year for each 10,000 renewal capex installment, which aligns perfectly with the case requirement. Now that we understand profitability at the income level, Alex will explain how this translates to the balance sheet and capital employed.
The balance sheet shows how capital is invested and reinvested over time, and it confirms whether the operating performance we just reviewed is financially sustainable. We first look at non-current assets. These increase from 110,000 in the first year to 407,000 by year 2031, or year 5. This reflects two things. First, the staged investment structure, 110k upfront and 220k at the end of the first year, and a series of 10,000 renewal investments over the first 4 operating years to maintain service quality and brand standards. Meanwhile, accumulated depreciation increases steadily, which reduces the net book value of assets over time. This is normal and expected, and because we depreciate evenly, the net non-current asset base follows a smooth, predictable decline, supporting stable reinvestment planning. Next is working capital, which is small, and that is strategically important. Since 100% of customer payments are immediate, accounts receivable is equal to zero. Inventory is tied directly to COGS through a 30-day cycle and payables through a 15-day supplier credit cycle. Therefore, operating net working capital averages from 6,000 to 7,000, which means the business does not lock up large amounts of cash in its operations, and this is a key strength. It makes the model cash efficient. In the final forecast year, we freeze. The change in operating net working capital is zero, and capex is equal to depreciation. This establishes a steady state condition, allowing the business to continue indefinitely without requiring further capital injections. With the balance sheet structure clear, we can now convert operating performance into real cash flows, which Juliana will present.
Now that we understand the operating profit and the capital structure, we can translate this performance into free cash flow to the firm, which is ultimately the basis of the project valuation. The key point here is that accounting profit is not the same as cash flow. So, to assess whether this project creates economic value, we need to examine how much cash the business generates, how much of that cash must be reinvested to keep operations running, and how much is actually free to compensate investors. For this, we use the standard corporate finance formula, which is equal to EBIT plus depreciation minus capex minus change in operating net working capital. Here, EBIT captures after-tax operating profitability, depreciation is added back because it's a non-cash expense, capex represent real cash outflow tied to investment in the physical operation, and change in operating net working capital measures how much cash is tied up in inventory and supplier timing. In our project, free cash flow to the firm is negative in the first 2 years, minus 110 due to operating investment and minus 111 in the second year when the remaining investment and the first renewal capex occur. This pattern is typical and expected. Restaurants have an initial investment phase. However, from 2028 onward, once the restaurant is established and margins stabilize, the business becomes a consistent cash generator, which is perfectly visible on the graph. There are several ways to calculate the payback period. However, we applied the straightforward formula, the number of full years before recovery plus the remaining negative accumulated cash flow divided by the next year cash flow. Using this approach, our project's payback period is around 2.75 years, or about 2 years and 9 months. There are substantial free cash flows relative to the scale of the initial investment, and importantly, they're stable, so not dependent on optimistic growth assumptions. In 2031, we apply an essential perpetuity assumption. Capex is equal to depreciation, meaning we only reinvest enough to maintain the business, and the change in operating net working capital is zero, meaning working capital stops absorbing additional cash. Under this steady state condition, free cash flow to the firm equals EBIT, which is equal to 105,000.
So I'll wrap up by explaining what these numbers actually mean and what conclusion we reach. By the time we get to year 31, the business has settled into what we call a steady state. Basically, at that point, the restaurant is running normally. It doesn't need extra investment to grow, just the usual maintenance to keep operating. That's why in that year, our free cash flow comes out to 105,000. And that becomes the level of cash flow we assume the business can keep generating every year going forward. Now, even though the first perpetual cash flow is actually received in year 32, we place the terminal value in year 31 because the value formula looks at the year before the perpetuity begins. And since we assume no growth in perpetuity and our discount rate is 12%, we use the following formula to calculate the terminal value and we reach the value of 881,000. Then we add the cash flow of that last year itself, which gives us the total cash flow in year 31 of 987,000. After we discount all cash flows back to today at the required return of 12%, we get the NPV value of 623,000. That's the key number. It tells us that the project creates 624,000 of value above the cost of capital. So just from the NPV alone, this project makes financial sense. Then looking at return metrics, our IRR is 64%, which is way higher than 12%. That means that the project has very strong return potential. We also show the MIRR, which is 48%. This one assumes reinvestment at the discount rate, not at the IRR, so it's more realistic in practice. So, a simple way to explain this too is that IRR shows the upside potential while the MIRR shows the grounded realistic return. And in our case, both are well above the required return. So, overall, the business generates stable cash flow, it doesn't require ongoing heavy investment, and it delivers returns that are significantly higher than the benchmark rate. And because of that, our conclusion is that this project is financially sound and we definitely recommend moving forward with the investment.